Did you know that Warren Buffett, one of the richest billionaires in the world and the CEO of Berkshire Hathaway, brought in $3.5 billion in dividend income in 2023? That's about $400,000 per hour or $6,600 per minute or about $110 every second. Now, I'm not saying that you're going to become Warren Buffett if you invest in dividend paying securities, but if you have the correct investment strategy for your early retirement journey, you could end up replacing 80% or even 100% of your current income with dividends. And what if I told you that you could live on dividends without paying any taxes? What I want you to take away from this video is to have a complete understanding of dividend investing so that you can take it into consideration, even if it's not something you're doing now.
I understood the assignment.
So the objective of an early retiree is to build an asset that's large enough to have moderate income that isn't too safe, but it is also not too risky. And there are options like investment grade corporate bonds and preferred stocks, but I want to stick to the dividend paying common stock for today's video. And I want to make it as simple as possible so that you have a clear understanding of dividend investing. And when it comes to dividend investing, believe it or not, you're probably already doing it. If you invest in an S&P 500 index fund, it already comes with dividend payments every year. And this one right here is the Schwab S&P 500 index fund dividend payment history. As you can see here, this index fund pays its investors dividends once a year in December. The next one is from the Fidelity S&P 500 index fund dividend payment history. This index fund pays on a quarterly basis. And the next one is from Vanguard. This is a lot of people's favorite. Vanguard VFIAX. And do you see where it says 30-day SEC yield with 1.38%? So 1.38% is how much the Vanguard S&P 500 pays its investors dividends every quarter. This one is every year, but then every quarter is being distributed out. And you could have the index fund in a 401k, Roth IRA, HSA, or a simple taxable brokerage account. And chances are you're already reinvesting the dividends they pay out either every quarter or every year. And if you take a look at how well the S&P 500 has performed in the past 10 years, it either accounts for dividend reinvestments or without them. Some people choose to cash out their dividends, but a majority of the people reinvest right back into the same index fund. And let me show you how it works. The S&P 500 in the last 10 years, from February 2014 to February 2024, has performed a total of 172% return or 10.5% in annualized return. This is assuming that you never reinvest your dividends back into your investments. But if you reinvested your dividends back into the index fund, you would have over 226% in total return or 12.5% in annualized returns. Now, I know some of you would try to argue with me in the comment section that a 12% return was not the case in 2022, but if you really pay attention to what I'm saying, it is a 12% annualized return. That means it's an average of 12%. Not that you make 12% every single year. If you bought the dip in 2020, which was at the beginning of COVID in March 2020, or throughout the bear market of 2022, your returns will be much higher. And if you choose to sell when the market was down, or if you chose not to buy any more shares during the market downturn, then this is the average return you're going to get for the last 10 years, if not lower. Okay. So let me give you an example. Let's say you have $10,000 in a security that pays 1.5% in annual dividend yield, assuming that the share price doesn't change. The 1.5% will remain the same. On one hand, there is the capital appreciation. As the share price increases, there's going to be capital gains in the security. If the share price decreases, then there's going to be capital losses in the security. That makes sense so far, right? And on the other hand is the dividend payments. This is completely different from the capital appreciation because it's a form of cash payment to the investors, kind of in a way to thank the investors for investing in this security. So in this scenario, with $10,000 with 1.5% in annual dividend yield, that will be $150 in annual payment. And one of the options is to have it paid out directly to you so that you have the option to invest in other stocks, ETFs, mutual funds, or spend the money for whatever you want. The other option is to reinvest right back into the same security by purchasing more shares. You have the option to pick this every time you buy a security. If the security pays some form of dividends, you have the option to do so every single time. And this is probably the most important piece of information you need about dividend investing. Just because you investing something that pays you dividends, it doesn't mean that you're going to get the same capital gains tax treatment. You need to know the differences between a qualified dividend and a non-qualified dividend. Otherwise, you're going to get hit hard during the tax season. So I encourage you to pay attention to this part. And a qualified dividend needs to be paid by a U.S. corporation or by a qualified foreign corporation. A qualified foreign company just needs to meet one of the three conditions. The foreign company was incorporated in a U.S. possession. The corporation is a part of the income tax treaty with the U.S., or the foreign stock is traded on the U.S. stock exchange. For example, there's a company called Novo Nordisk that is a pharmaceutical company from Denmark that is traded on the New York Stock Exchange. When the company pays out dividends to its shareholders, it's considered a qualified dividend because of that reason. Whenever you invest in a foreign stock on the New York Stock Exchange, the dividends could be categorized as qualified dividends, right? But make sure to confirm that before you invest in any foreign securities. You also have to hold the stock for a certain period of time. Now, I'm not going to talk too much about preferred stocks since most of you are common stock investors. For common stocks, which is what most of you invest in, require you to hold more than 60 days during a 121-day period, beginning 60 days before the ex-dividend date. And if you meet these requirements, then you're going to be taxed at 0, 15, or 20% long-term capital gain tax rates, okay? And here's what's considered a non-qualified dividend investment. Besides not meeting the requirements to be a qualified dividend, you have to understand that not all U.S. companies are corporations. Real estate investment trusts and master limited partnerships are not structured as corporations for tax purposes. The IRS considers REITs as pass-through income because at least 90% of the profit a REIT makes is given out to the shareholders as dividends. And so REITs are one of the probably the most popular investment options in people's portfolios. But the bottom line is that the dividends you receive from REITs and MLPs are going to be taxed as ordinary income. And a lot of times, when you first purchase a stock, ETF, or a mutual fund that pays dividends, you just don't meet the 60-day holding period. So you might have a combination of both qualified dividends and non-qualified dividends from one security on your tax statement, depending on when you purchase the security. Non-qualified dividends is taxed under the federal income tax brackets at 10, 12, 22, 24, 32, 35, and 37%. If you're a high income earner, you need to especially pay attention to how much you get paid in dividends every year. And it doesn't matter if you're reinvesting your dividends right back into the stock, you still have to pay dividend taxes every year if your stocks are not in the tax deferred investment accounts. If your entire taxable portfolio is in REITs, then you could potentially put you in a higher tax bracket. By the way, did you know that over 50% of Americans who make over $100,000 a year are living paycheck to paycheck? So is it always an income problem or a spending problem? If you're having trouble figuring out your budget, I encourage you to download a budget app called YNAB. YNAB stands for You Need a Budget. That's right. Whether you make $50,000 a year or $200,000 a year, every one of you needs to create a budget to achieve financial independence. You need to give every dollar a job so that you can be more intentional with your savings and spending. You can get a free trial without any credit card information by using the link in the description below. And here are some dates that you need to be aware of when you research dividend stocks, ETFs, or mutual funds. Most of them pay their dividends on a quarterly basis. Some companies choose to pay out their dividends semi-annually or annually. And sometimes a few companies will pay out extra dividends to their shareholders on a non-scheduled dividend payout date. And I remember when, let's say Costco paid out what's called a special dividend to their shareholders because 2020 and 2021 were really good or very profitable years for them. And nobody, not one company, is obligated to pay special dividends to their shareholders. But when it happens, usually it takes the board of directors to vote on it. It's usually because they have excess cash available on their balance sheets or they want to show confidence in their long-term value. So first, the declaration date is the date when the company makes an announcement that it will be issuing a dividend in the future date. Second, the record date is when the company looks at its current list of all the shareholders to determine who will all receive their dividend payments. Third, the ex-dividend date is the date the company determines which of its shareholders will be entitled to receive the dividend payment. Only these shareholders who hold a company stock prior to this date are entitled to receive the company's dividends. And finally, the payable date is the payment date. It's kind of like when you get your paycheck. And that's when the company pays out the dividend to the eligible shareholders. So let me give you an example. If I bought an ETF on March 1st that pays dividends every quarter, and the ex-dividend date for the ETF is on April 30th, then that's exactly 61 days I've held my ETF out of the 120 days, which dates back to January 1st. So the dividend I receive will be taxed at 0, 15, or 20%. But if I bought the ETF, let's say on March 2nd, then that's 60 days I've held my ETF out of the 120 days. That means the first dividend payment I receive will be taxed as ordinary income tax at 10, 12, 22, 24, 32, 35, and 37%. But if I hold a stock even longer, then the next 3 dividend payments will be taxed at 0, 15, or 20%. And I know this can be complicated sometimes. So if you're interested in joining my private client program, you can schedule your first free session with me for absolutely free twice by visiting 568.com/coaching. So your tax form will look something like this. The first block right here tells you how much of your dividend payment was non-qualified dividends, so you'll be taxed as ordinary income tax. The second block right here on the tax form tells you how much of your dividend payment was considered qualified dividends, right? So you'll be taxed at the long-term capital gains tax rates at 0, 15, or 20%. Most of us will be taxed at 15% or less. Again, you have to keep in mind that whether they pay you dividends directly or you choose to reinvest your dividends every year, you're going to get the Form 1099 div to pay your long-term capital gains tax or ordinary income taxes. You can legally avoid paying dividend taxes while you're still actively working if you invest with a 401k, Roth IRA, or HSA. You don't get taxed for dividend distributions or dividend reinvestments in those retirement accounts. And I'm going to talk more about the tax savings on Wednesday's video, so be sure to subscribe if you haven't done that already. And these are the 2024 dividend tax rates. The 0% tax rate right here is why it is so attractive to the early retirees, because they're not gonna have access to their 401k, Roth IRA, or other retirement accounts until they're at least 55 or 59 and a half years old. As a single individual, your first $47,000 in dividend income is not taxable at all. If you're married and filing your taxes jointly, that's $94,000 in tax-free dividend income. Pretty awesome, right? But keep in mind that if you have other income coming in, you have to calculate your ordinary income tax first and then calculate how much of your dividends will be taxed at 0% and the remaining dollars at 15%. Even if you go over that threshold, the 15% tax rate is still far cheaper than the federal income tax at 22, 24, 32% or above. Warren Buffett, the billionaire, knows this too. Why do you think multimillionaires and billionaires invest in stocks? It's not only because they're a great hedge against inflation, but the tax rates are significantly lower than the federal income tax. You actually end up paying more in taxes as a W-2 employee than you do as a long-term stock investor. Whether you're opposed to that policy or not, that's the game Congress handed us. So you can either keep opposing it or take advantage of it. But something else that you don't want to forget about is the standard deduction. What this chart doesn't include is the standard deduction for single, married filing jointly, married filing separately, or head of household. It says $47,025 for the single individuals to maintain the 0% tax rate. But if you add the standard deduction, it's actually $61,625 to maintain the 0% tax rate. If you're married and filing your taxes jointly, your annual dividend could be as high as $123,250 to maintain the 0% tax rate. Imagine just living on the dividend income with over $120,000 a year and paid $0 in taxes. That is the ultimate life hack that people on the financial independence journey found so that they could retire early. So let me give you the breakdown of the 0% tax rate. These are the standard deduction that I was just telling you about. In order to maintain the 0% tax rates in the year 2024, assuming that you have no other income sources, these are the amounts you want to be under to enjoy the tax-free distributions. Now, is it going to be bad if you go over $1 above that threshold? Not really, right? What's 15% of a dollar? That's only 15 cents. Even with $1,000, that's only $150 in dividend tax. And if your portfolio is yielding 3% annually, the total investment with a 0% tax rate will be about $2 million if you're single, 4 million if you're married, and about 2.8 million if you're the head of household. And if your portfolio is yielding 4% annually, then the total investment amount will be reduced significantly because your investments are paying higher dividends. And as far as how long it takes you to save enough money to replace your current income, you can download my financial independence calculator for absolutely free by visiting firestarchat.com/resources. I'm not going to go over the entire calculator because I already did a video on the calculator in the past, but when you try to calculate your early retirement numbers, make sure you select your desired retirement age before 55 in one of the blocks, and you're going to be able to figure out how much you need to invest every month and every year to reach your investment goal. Is focusing on dividend investing right for everybody? Not necessarily. If you only invest in dividend paying stocks, the growth might not be as much as the other investments that don't pay dividends at all and only focus on capital appreciation. There are some exceptions though. The S&P 500 index fund, for example, has been growing 13% on average annual return with dividend reinvested. And there are also dividend paying ETFs that have grown tremendously every year. Meta is a stock that grew over 175% in 1 year, and they just started paying dividends to their investors. Does it mean Meta is going to stop growing? Of course not. Mega companies like Tesla, Google, and Amazon have never paid dividends to their shareholders because they choose to reinvest their profits right back into their companies to grow their companies bigger and bigger and to pay their employees as well. So you have to choose and diversify your portfolio carefully based on your current age, your tax situation, and your risk tolerance. If you want to truly become financially independent, take some time today to read about dividends, preferred stocks, common stocks, and investment-grade corporate bonds, and many other bonds. And let me know in the comment section down below about your thoughts on dividends.